All right, here we go. So first of all, welcome to everyone who has jumped on this webinar tonight as we talk about one of the number one reasons that women of color struggle in growing their business, which is funding. I am super, super excited to partner with Ebony Grundy. Did I say it right?
Yes, you did.
Grundy, who is from Bank of America, a vice president of Bank of America in commercial, what did I see it on there?
Commercial banking.
Commercial banking. Thank you. Thank you. And I'm excited because I met Ebony at one of our networking events. We had a conversation. We followed up with that conversation and we continued to have a conversation until this was ready to go for you. Super excited about her being a part of helping us to get the information that we need to position ourselves to be able to receive funding, especially when it's time to go and to grow. And so, Ebony, if you can just share your background and history with everyone real quick, that'd be great.
I can do that. Uh-oh, my screen is changing.
Tell me when you want me to share. I can share it with you as well.
You can go ahead and share now. Share the screen.
Okay, let me do that now. Actually, I think you go down.
Yeah, I can do it.
Yeah.
Okay, let me try this.
Hit the share button and it'll turn the screen around. There we go.
Okay, you can see it now.
Mm-hmm.
So yes, I will be happy to share my background. It's actually one of my first slides, so that's why I was trying to get to that point. So thank you for that. So Ebony Grundy, like she mentioned, I'm currently vice president, one of the many vice presidents of commercial banking at Bank of America. I've been in commercial banking for probably a little over 15 years, and then to some extent always doing some level of advising to business owners. A lot of people say, what's commercial banking? What's business banking? What's the difference? Most of it has a lot to do with the size of your business. So every bank defines and puts these size of business buckets in different categories. For Bank of America, commercial banking would be like 5 million, a business with 5 million in revenue up to maybe 100 million. And then you kind of have different buckets of what that means. So usually small business could mean something, anywhere for up to 2 million at a bank the size of Bank of America. For a smaller community bank, small business could mean, less than $1 million. So don't let that throw you off. Business banking and commercial banking just means banking for businesses versus personal. And part of that selection process has to do with, as a business owner, what type of bank is good for your business. So I've been doing, like I said, commercial banking for 15 years. I started in Wisconsin, banking with smaller businesses, what they would just call the C&I business, just general businesses, not a specific market. And then I kind of developed a niche for healthcare businesses. That took me down a different path, had me relocated to Georgia. So worked a lot with hospitals, universities, and government entities. Obviously, that's not our focus tonight, but what I have been doing over the past few years is advising for small businesses, which the premise is still the same. And part of where we miss the gap is what businesses really look for from minority-owned businesses. We don't understand what banks are looking for. So that's part of the strategy is to talk about what your business needs to look like to get approved for any kind of funding, whether it's a loan or an investor.
That's what I love. I'm excited about that.
I'm excited too. Now, it's not going to be an easy process, but part of what we have established is that knowing that what you should do is part of the process, right? And it's not going to happen overnight, but it's part of a building process, kind of like, I know I have to do X, Y, and Z before I even go into the bank, or, look for an investor. And there's so many different forms of funding nowadays. There's some basics that you need no matter what.
Right. And I think that's the big piece is we don't know what we don't know. And so just to get the information will help us along the journey.
Absolutely. So feel free to ask me what you don't know, because I'm sure somebody is thinking the same questions as
Yes.
somebody else. Your questions will be very helpful. And that's kind of our goal, is to answer those questions. But part of that is also to minimize frustration, right? People have all these assumptions and myths about, oh, I didn't get a loan because of X, Y, Z. So maybe I can debunk some of the myths and really focus on the real reasons why you may or may not have gotten a loan. And not that those things don't happen in general, but a lot of it has to do with type of service industry you're in, or the purpose of your loan. There's plenty of things that people don't understand and go into the loan approval process. All right, so with that said, we kind of did, the bio part already. We talked about doing the survey questions. They're going to be mixed throughout. But that's really to help me understand what we should talk about, right? Because there's such variations from industry to all kinds of things. So as we do the poll questions and people ask questions, I can kind of get to know what to focus on. Some important factors we definitely are going to focus on is what your business profile is. Part of this is understanding terminology. So if I say anything that doesn't make sense, please stop me so I can explain what I mean. We're going to talk a little bit about phases and stages of your business. Everybody talks about the business life cycle. But the reason why that is important is because you're asking for money from different sources depending on what phase of the life cycle you're in. So if you think you're a startup business and you're going to walk in a bank and ask for a loan, that's where we fail initially, because banks don't really lend to startups. That's not where you should get your first pot of money from. So we'll kind of talk about that. Financial literacy is obviously very key. And you don't have to be a CPA or an accountant. We can hire people for those things, but it's important that you do, because that's understanding your business. And we can talk about that a little bit more too. Having that financial professional in your business, if it's not you, really talks and goes to understanding the value of your business, whether it's comparing to your peers, your industry, or even the type of activity. And when I say activity, I mean, are you a merchandising business? Are you a manufacturing company? Are you in the service business? All of that matters when it talks about the value of your business versus your strategy, right? Because if you're requesting money from a loan from a bank, they want to know how sustainable it is. So you can't just go in and say, well, I think, revenues are going to be X, Y, Z. You got to understand your industry, your value, before you can ask anybody else basically to invest in your business. All of that obviously leads to access to capital, which there are so many resources for that. You kind of have to decide what's the best resource for your business. But if you don't understand your business profile, you could be barking up the wrong tree, right? So we'll go on that a little bit, and then we'll take questions. So I do want to start with one myth that people think: collateral is the most important criteria for a business loan. That is so far from the truth for several reasons. Banks in general, and maybe investors on the hard scale, but there's something called the 5 C's of lending. Collateral is like somewhere in the middle of that, because if you talk about, I want a loan, and please give me this loan because I have my car as collateral, the bank doesn't want your car. So they don't want to know what your collateral is. They want to know how you're going to repay the loan. It has nothing to do with the collateral. So the myth that, all I need is collateral, and then why didn't they give me the loan? That really has nothing to do with the initial reason they give you the loan. The very, very first and most important thing any bank or financial institution wants to know is, how are you going to repay the loan? That's what we call cash flow. That's that money flowing in and out of your business. So part of the financial literacy part is understanding your actual business cash flow, who you pay and how you collect. That has to do with, does it take you 30 days to collect or 45 days to collect? All of those things are important to repaying a loan, and a loan decision is based on repayment. So if you don't understand that process, chances are you're not going to get a loan. I don't care how much collateral you have. Now, the point is, don't hold me to that, because if you walked in the bank and said, I have $50,000 in cash and I want a $50,000 line of credit, we're going to say yes, but if you had $50,000 in cash, you don't need a line of credit. So that is considered collateral, but cash is different. We're really talking about the reasons why you really want a loan. You need to be able to repay that loan.
Now, part of the 5 C's, cash flow, collateral, I know conditions is one of those. I can't think of the other two that's a part of it.
Character and credit history.
Character and credit, that's right.
Well, they really are the same thing.
Okay.
Really, for personal loans, they talk about credit history. It's really the same thing as character, because they want to know the character of your business.
Yeah.
Do you repay your debt?
Yeah.
Let alone if you can. And so personally, we have credit scores, right? For
Mm-hmm.
business, you have a DUNS score, you've got all DMB and like things like that. But for your business, character for us really means I get to know a business owner.
Okay.
And we talk about having an advocate. When you really think you're ready for a business loan, you want to have an advocate at the bank, somebody like myself, who is a relationship manager who deals directly with you. That's how you build character. They understand that you understand your business, in addition to just a credit score. So that's one of the things that is important, is actually establishing that relationship with somebody in the financial institution that's really going to be your advocate internally, versus filling out a paper application.
Gotcha. Okie dokie.
So we covered all 5, right? Conditions. Yep. Okay, perfect. Okay, so let's get started in general with, oh wait, we did my bio already. We don't have to do that again. But I do want to do the first polling question.
Okay.
So you want to go ahead and do the first one?
Which one was it? Was it the
very first one on the list, what stage in the business cycle?
Okay, here we go. All right, I'm going to put this out here, guys, and this is a poll. I want you to just answer based on where you are. This was the what stage?
Yes, the what stage.
What stage in the business cycle? Okay,
so
launch poll.
This question, while we're doing the poll.
There we go. The poll should be available. Are you able to see the poll?
Yes, I can see.
Okay, so the poll, what stage in the business life cycle are you in? If you will just click on one of those, for the poll, we'll give you a few minutes, everyone that's on, if you'll just click on, so we can kind of get a gauge of where most people are.
And the reason for this question has a lot to do with the type of funding requests you're seeking. Certain funding requests go better in certain stages of the life cycle.
Gotcha.
The seed and development stage is really too soon for you to go to a bank, right? Because we talked about banks want to lend money on cash flow. You don't have cash flow if you're in seed and development stage, right? So it's kind of like, depending on what phase you're in, you got to understand where you're going to be looking for your money.
Gotcha.
So the seed and development stage is really the idea stage, and that's when you do most of your due diligence and understanding your concept. You want to make sure that you have a sustainable business idea. Depending on whatever industry that's in, you want to do all of your market research. That's when you want to check out your competitors. And once again, this all goes back to you convincing somebody that there's a reason they should give you money because you have a good business idea. You kind of got to prove it out before you can do proof of concept, which is actually implementing it. But the research is what comes into play there.
These are the results for everyone based on launch and startup, usually less than 2 years. The majority, 52%, is launch and startup, 24% in growth establishment, and then the third one is 20% in seed and development. So there's some idea generators out there, some who have just started, and then some that have started and been in business.
Okay, awesome. That's a nice variety. Definitely what is expected, because we all know the statistic that most businesses fail after 3 years. So it's one of those that if you can kind of get the formula right in the beginning, once you make it past that 3rd year, that's where we talk about sustainability. And, so we talked about seed development. That's the due diligence concept of your seed stage. As you launch, that time period can be different for businesses. And once again, that has to do with understanding, your industry. Some, if you're in some kind of IT business, your R&D could be, 2 years on its own. So you really have to take that into account, especially when you're seeking investments. This is not like a hard rule, like less than 2 years, you're still a startup. What I do want to point out is that when you go to a bank, if you are less than 2 years old, they consider you a startup. So regardless of where you're in that cycle, they kind of just throw the 2 years out there. If you came to me and said, Ebony, I want a loan, I'd say, show me 2 years of financial statements at least. So that's kind of a good benchmark there to understand that it's not that you can't get a loan. It's just one of those check marks that they say, you know, we don't lend to startups. If you're less than 2 years, they're kind of talking about you. But that's for the cash flow reason, honestly. So if you're in the growth mode, you're really at a point where revenues are sustainable and growing, and that's the spot banks love, okay? If you're in that mode, then we can see your 2 years of history, and we can see maybe you do need a loan now because now your business is growing and you need to fund that growth. Expansion mode, the same way. Now you're maybe looking to buy another piece of real estate or another building. Banks like to fund in that mode as well. And we don't have anybody in the maturity mode, which is the great pace to get to, because obviously your ultimate business goal is to either, you know, run the business forever or pass it on to somebody else or sell it. However it is, when you get to that mode, usually you don't need much funding. You're looking for your exit strategy, whatever that is.
Mm-hmm.
So that pretty much explains the life cycle. So another myth that I hear a lot, business loan approval guidelines function the same as personal loans. Not even close. Now there is a gray area when you're dealing with a smaller business, and that is really because a lot of it is still based on your personal financial strength. But once you get past your startup phase, that's really less of a factor. So if you can look at the timeline, the more you show your business is sustainable on its own, the less we're concerned about you personally. Not that you want to be bad personally.
Right.
It's more like the sooner you are in that startup phase or launch phase and you're asking for funding, the more reliable we're going to rely more on your personal financial strength.
Okay, gotcha.
So that's really what that means. And even business loans, to a certain extent, when you get to a larger level, there's no application process. You're not walking in, filling out a piece of paper saying, you know, this is the purpose of my loan. This goes back to the relationship conversation. You're talking with a relationship manager and a banker and saying, this is where my business is, and let's talk about what I need, versus actually filling out an application and leaving it on somebody's desk. In that process, the relationship manager really becomes your advocate once again, and we're going through our internal process to say, hey, I have a new relationship opportunity. Let's talk about this business. So it's a lot of gray area rules with, you know, they've really been in business 18 months, but look, I can show you that they've already have sustainable cash flow. The 2 years is not a drop dead. If it's not 2 years, we don't look at it. But that's the other reason why you establish a relationship, so you can have that conversation to say, look, we got a really big contract year one. So even though we're less than 2 years old, I can prove that we have sustainable revenue.
Gotcha.
Okay, next polling question. Yeah, let's do the next question.
Okay. All right, next poll. Stop this one. And let's move to poll 2. Type of business activity.
Okay.
All right. So the question is, what is your type of business activity? Service, merchandise or product, or manufacturing? If you can take the poll right now.
So the service type of industry, you know, it's going to be you providing a service. So that could be a doctor, a lawyer, you know, some kind of service. And even if you're a consultant, whatever that may be.
Mm-hmm.
The reason why this matters is because, one, you're talking about, from an investor or funding standpoint, scalability. If your business is based on you and your service, might be a great business, but how scalable is it? And that's the point they're asking when you're looking for an investor or a loan. They want to make sure that maybe you don't want to scale, and that's okay. But from that standpoint, scalability is really where this business activity question comes into. So you want to understand how others look at scalability when they're considering your investment proposal. And I say investor and bank kind of tongue in cheek, because your bank is really investing in your business as well. They're not getting equity in return. It's one of the only types of investors that don't want equity. We just want to give you a loan and you pay it back, but we're still really investing in your business. So from a merchandise and product standpoint and a manufacturing product, This also doesn't surprise me because a lot of people of color are not in manufacturing.
Mm-hmm.
Unfortunately, banks love manufacturing.
They do.
They do.
They do. So many people that I know that have business that do manufacturing, they get funding and even grants and government contracts.
Absolutely. Let me tell you why. Because we can hang our hat on manufacturing. There is collateral there, right? If you're a service business, what collateral can you offer me after cash flow? You know, first we want you to be able to repay the loan. And your service business might be offering, you know, all kinds, offsetting all kind of revenue, and you're just got cash flowing for days, but there's still no collateral, right?
Yeah.
So it's kind of like tongue in cheek. Manufacturers, they have a lot of revenue, but plus they have collateral. So most traditional lenders want two sources of repayment, the first being cash flow, the second being collateral. That's why manufacturing is so highly coveted by banks, right? Because we can get that collateral piece. For the merchandising and product, that's kind of in between, right? Because that's one of those depreciation type things. If you have a retail store, we all know that once you buy something at a retail store, it's only worth half of what you bought it for. So banks don't really like that collateral, but it's better than nothing. So that's just a few examples of understanding the type of activity your business is in to understand what type of investors and what type of lenders are going to be attracted to your business. Unfortunately for us, manufacturing has the highest barrier of entry. You pretty much have to have some level of capital to become a manufacturer. You can't start that by saying, oh, I got a great idea, let me just pull the trigger.
Right.
You got to buy machinery, equipment, like all of this stuff that banks love to fund, by the way. But, you know, you got to start somewhere. So that's kind of where we don't really play in that space, honestly. I'm not sure I have a solution to that. That's just the reality. So when we talk about small businesses, once again, that can be different for different people, but usually the startup of small business happens with these buckets of money. You got personal credit cards, bank loans, family or friends, and alternative funding. So just so you can kind of see, and I think one of our polling questions is next, is what type of funding you have secured. That's pretty important to the overall strategy of how you're going to start your business. So when you're in that seed and development phase, don't be confused about where your options of funding are, because 76% of small business owners use their personal savings for startup funding. So once again, we're going back to that barrier of entry. If that many people use money to start businesses, I don't know how many of us can buy a $100,000 piece of equipment to start a business. You know, if that was the only cost, but that's really just part of everything that goes into it, which is why we start service businesses, right? Because we have that available to us, and we can get that going.
Here's the poll for the third poll. So based on what type of funding have you used, secured already? Friends and family, credit cards, bank loan, investor, venture capitalists, angel investors, or others. So take the poll and let's kind of get an idea of what's going on. You know, Ebony, just based on what we learned initially when you started out talking about the different stages of business and where and when banks can fund, just that information helped me to kind of get an idea of what this poll was going to look like based on where people were already.
Right. And you see how it's kind of coming together. It makes sense when you put the picture like that.
Yeah, it's starting to make sense, because I'm in this bucket too, where friends and family, a credit card. So I'm going to give a few more seconds on the poll just to get a couple more in. But right now it's trending 67% credit cards and 50% friends and family, and then 12% from investors, none for bank loans.
Oh, that's scary.
Yeah, I'm gonna share this poll. Let's end it so I can let everybody see what the results are. Here are the results.
Oh, wow.
Yeah, these are the um the results. And I think I truly believe a lot of why it's in these two buckets is because not knowing what you need going into a bank, or
Right.
even an investor, not knowing what that looks like, or because we will go into the bank and get a no, but we don't know
We
what
don't
we
know
needed to
why.
do to
Right.
get a yes.
Right. Right. And let's talk about what the real no is. And there's hard things and then there's some soft things, right? One of the soft things I talk about is called deal fatigue, right? So if you go in to your relationship manager at a bank and they ask for a loan and they ask you a bunch of questions, and you really don't know the answers to the questions, and you say, "Oh, I have to come back." It's not a problem to come back and not have the answer, but something called deal fatigue will happen where they can't keep bringing the same deal to their boss. Like, I can't keep going back and saying, "Okay, well, now this and now this," because you basically lose credibility, right? As a business owner, you don't know your business that well. If I'm asking you all these questions and you don't know it, so sometimes people just get denied because of that intrinsic value of, you just didn't know enough when I asked you the first time, and now we don't want to talk about it anymore. Still could have been a very good idea, but this is
Mhm.
about getting your ducks in a row before you go in. If you can knock out 85% of what they're going to ask for, we always go back and forth with questions, but it can't be something basic as your profit margin. Like, I need you to know that before you get here. So deal fatigue is a big reason, but that's just about education. That's being knowledgeable enough about the information that they need before you go in there.
Got you. Someone asked too. So first of all, if everyone can kind of mute their devices, because someone's getting some feedback, and it's probably through a phone. But someone asked about manufacturing. What are some of the examples of manufacturing businesses?
Let's say a widget is a generic example, but anything that
Hmm.
you're creating originally, like whether it's a product like a bar of soap, you have your own soap line, or you have, a clothing line if you were manufacturing the clothing line, not just designing it, but
Yeah.
jewelry if you make jewelry. But large, big ticket items manufacturing would be like, somebody who makes the signs on the road. That's a large manufacturing business that they have to
Hmm.
purchase very pricey equipment to manufacture those signs. It could be manufacturing glass bottles. It could be manufacturing textiles. It's really the things that
You're making yourself.
correct. Yeah. And you have to remember that it's got to be tangible enough that it doesn't lose value. There's certain things, like if you were manufacturing cars, they don't necessarily lose value if somebody else had to come in. If I was the bank and I had to come in and take your fleet of cars, I'm going to be able to sell them for the same amount you were going to be able to sell them for. So when the bank is looking at the value of collateral, they want to make sure they can resell it for the same thing that you could have sold it for, even after it was not used. There's certain
Yeah.
things that the bank doesn't want to try to sell a bunch of pair of kid shoes. That really has no value. So it's one of those things that things that maintain value are really what banks like from a collateral standpoint.
Gotcha. Don't forget, you guys can hit the Q&A button at the bottom and post your questions there, and we'll make sure we answer those questions before we get off the call tonight.
Okay. So, and that question actually leads into this next, the reasons why small businesses apply for loans is to invest in equipment. Like manufacturing equipment is like one of the biggest reasons that you would need capital. You're kind of looking at it like, let's say I got a contract and I need to create 100 widgets, and then I got another contract that pushed me to 1,000. Now I need another piece of equipment to do that. So whether that was, making kids puzzles or whatever it is, if you need equipment to increase your volume, that's what the bank likes to see. Oh, you've got additional revenue opportunity. We want to be able to invest in you getting your equipment.
So are you saying that you can't go and apply for a loan because you need advertising dollars, money to advertise your products or services, or to gain more attention? Because that's a lot of times that's what people are saying. Well, to grow my business, I need to be able to have money to grow my business. But some of the areas in where they want to grow, because marketing and advertising dollars is a big part of growth in business. I don't know if a bank is just giving you money just to advertise.
Well, it's not that quite cut and dry, but you see that's number 4 on the list, right? To market the business. So that is a true, what we call working capital cost. Like that is a true cost of business, and banks understand that. Where the issue becomes is if you're a startup and you need marketing money, nope, we can't help you. But if you're an established business and need some marketing dollars, all you have to do, that's where you show me that you can repay it. And the question then becomes, how much can you repay in addition to your current obligations? So if you talk about budgeting and cash flow, this is where the financial literacy part comes into play. You start a business that you're generating $1 million a year, which is great, but that means you don't get $1 million line of credit for marketing. You got to understand your marketing expenses need to be comparable to your peers, which is part of understanding your business, right? Some businesses have higher marketing costs than others. So as you're doing your research, that's what you're going to the bank. And believe me, Bank of America, for example, has enough clients to know that if you came to me with whatever kind of business you had, I can compare it to a peer. And your costs are way off. You're trying to spend way too much on marketing. And that's kind of the value you get when you become a true business owner and find a relationship manager. They're going to add value to your business and say, hey, you really should only be spending $200,000 in this business. You're a consultant, or an attorney, for example. They've got all these websites for attorneys to advertise. Look, you can get away with doing $100,000 if you have $1 million in revenue. And that's kind of the benefit of establishing a relationship with a banker, because you're going to get that other kind of advice that maybe you couldn't Google. So to answer your question, yes, we will fund marketing costs, but not for a startup, because you can't prove that you can pay it back.
Yeah, you don't have proof of, okay, got you.
So that's really where, just a regular working capital line of credit comes in. When banks give working capital lines of credit, that's what we're funding is working capital. But there's a gap, and it comes to financial ratios and all this other kind of stuff. There's a gap of, yes, you can repay the loan, but you have to be able to repay it at 1.5 times. And then, yes, we'll give you a $500,000 line of credit, that kind of thing. So that's the part that we take your financial statements and do an analysis and say, this is what we think you can afford.
Gotcha.
So here are the things: hiring new employees, investing in new technology, which is, becoming more and more popular, right? Even for restaurant owners, they're having to invest in so much technology because of all the delivery companies that deliver to restaurants. Like I have a restaurant client now that is having to spend more money on technology than he ever did, because more of his business comes online than walking in the door. So that again goes back to understanding your industry. What are the trends? And when you go to the bank, do you understand that the bank already understands this? So you want to look like you know what you're talking about your industry.
Gotcha.
So any questions there?
Let's see. Yes, there are a couple. Let's go through. Okay, so Randy asked the question, did you state that in the startup phase, banks consider you 2 years old? Is that based on revenue stream or 2 years of establishment?
So that I understand your question. So, there's the date that you established your business. And from a traditional banking standpoint, we are really talking about show us 2 years of financial history. So if you started your business, January 1st of 2010, but didn't do any business until 2011, you're not going to be able to count that year. We're talking about 2 years of financial history.
Gotcha. So financial history, when money is coming in.
Correct.
Okay.
Or going out.
Okay, true.
But some people invest for the first, have to invest in equipment and all those kind of things. You just want to be able to show we've been operating for 2 years, and that established date doesn't necessarily show that.
Question from Jershelle is, what is the likelihood that banks will fund equipment for consultants who are offering training and providing presentations for groups?
Well, it's likely depending on a few things. If you can show that your business is generating revenue, the purpose of the money, equipment is a good purpose for a bank to say yes to. Very legitimate business purpose. We like to say yes to business purpose requests. So the purpose is great. You just need to be able to show that you have enough cash flow to repay that equipment purchase. Part of that comes into depending on the type of business, I know people get grants and people get contracts and things like that. Where we were getting to later, which has to do with that, is banks don't like projections. So that's the whole point of the 2 years of history. Like, it's great that you have this contract, but you can't get a contract day one and think the bank is going to put all their stock in that. You still have to know that 2 years of history. So if you're going to be providing training and things like that, you have to show that you've already been doing that.
Right.
For that to happen. And now that's if the loan is based on business cash flow. But remember, we're also talking about, in startup phase, a lot of this is based on personal credit strength. So sometimes, depending on the type of equipment, you could get a credit card and buy that equipment with the credit card. That type of approval process is not the same as a bank loan. You know what I mean? So depending on the cost, something like that kind of equipment, you might be able to find other ways to get that capital than just a traditional bank loan.
Gotcha. And then there's a question, let's see, from Amelia that is asking, are you able to get a grant if you have a for-profit type business?
I think so. I think the grants are not just for nonprofits. We talk about grants a little bit later, but grants really have a lot to do with restrictions and purpose of money. Whenever you borrow money or receive money, everybody wants to know the purpose. The grant is the most restrictive purpose.
Right.
To say it like that. So for profit or nonprofit, I think grants are available for both, but it really depends on what you're doing.
Right. And the guidelines to the grant. Grants are very specific in detail of what they are willing to fund money towards. So if what you're doing doesn't fall within that time, expectation of what they're funding, if it does, then there's definitely a possibility to be able to get grants based on what what the grant is requiring.
I would say it's less common, but I'm not going to say it's impossible. And it really just depends, like you said, on if you fit the criteria for the grant. And a lot of them will say nonprofit. So if it says that, then you can't qualify for that grant. So another myth, a good business plan will get you a loan. Unfortunately, that is so not true. And so many people spend so much time and money on business plans. Business plans don't have a purpose, but I've been a banker my entire professional career, and I have never looked at a business plan for a company that I am getting funding for.
Wow, that's so good to know. Because people will spend a lot of time. I got to get my business plan together.
Now, here's why you want to do the business plan. It's for your purpose. You know that you are achieving your business goals. And if you don't create a plan, then you're just kind of kamikaze, making decisions like, oh, we should try this today, try that tomorrow. But I'm just saying that it is not for the funding purpose, especially banks. I will say that investors don't make decisions off business plans, but that's how they're introduced to your idea. So they're not giving you the money because the business plan was good. They're giving you the money because you introduced the idea and then you prove the concept. However, they ask you to approve it. But a business plan does not close the door on a funding option.
Yeah, everybody's excited about that information. Like, what? Oh my goodness. Thank you.
Right. I'm not saying don't do it. I'm just saying that taking it to the bank is literally not even worth it.
Yes. That is definitely good to know.
Your business plan for me is your 2 years of financial history. Like, show me that. You know what I mean?
Gotcha.
Do we have, I think we already did this polling question. Did we do that one? Yeah, we did the type of funding.
You're seeking funding. That was the next one.
Yeah. Are you currently seeking funding? I'm sure everybody's going to say yes, right?
You ready for that one?
Yep, sure.
All right, let's put this poll out there. Are you currently seeking funding for your business? Say yes or no. Let's see.
I can only guess what that one is.
Yes.
The reason why you're on this call.
I'll give you a few more seconds to finish up this poll.
So while that is happening, I'm just going to start talking about all the sources of capital. We had the poll earlier that talked about, have you already secured capital? And family and friends are obviously the biggest one. I want everybody to take note of this page because this is kind of where we started talking about if you're looking for capital, this is the type of capital you should be looking for depending on what phase you're in. So friends and family, that's where you get the seed phase from. The caveat to that is sometimes investors will look at your company, and if you didn't get friends and family capital in the beginning, they want to know why not. And now it kind of goes to like the character part. Like if the people that know you weren't willing to throw some money in,
wow,
why would I? So you really have to be conscious of trying to get that friends and family phase done. If not just to show that you have a legitimate business idea that's supported by the people around you. So I just like to point that out to people because some people are like, oh, I didn't need it. And I used all my personal money, but I'm like, it shows credibility if you can get some other people to invest in you.
Yeah. Yeah, I mean, that makes sense. Never thought about it from that standpoint, especially as it relates to the character part of the C is, no, I didn't get any friends and family money. Red flag.
But you're asking some random stranger for money.
Right.
Right. People
right.
that wouldn't invest in you. But, and remember, and this is, could be a whole class about types of funding and what that means. Funding sources can be equity or debt. Debt is money that is given to your company and you repay back. Equity is maybe somebody puts money in your company and now they own a percentage of your company. And then like the previous person asked about grants, sometimes you don't even have to pay grants back. But all of those things come into play when you're talking about different levels of funding. So when you look at this slide, I want you to look at it like these are phases. It doesn't mean you pick 1, 2, or 3 in a certain order or stop at any. It's really a building process. You start with the seed phase, and you might get $100 and then pay it back. At least you got some seed money. But part of that is building character and building the financial health of your business, showing that you're able to secure capital and repay it. That is part of financial strength of a business. There's all kinds of accelerators and business incubators popping up. That's another funding source that once again shows that somebody believed in your concept. And they will give you sometimes seed money, but definitely more in the startup phase, where usually it's some level of application and approval process where they say, oh, we like this idea, you're qualified, and we're going to give you 20 grand and help you do X, Y, and Z, offer you different resources or whatever the case may be. But that's also in the seed and startup phases. So wow. As you move down the ladder, now you're looking at angel investors and groups. Angel group is really a group of angel investors, but sometimes they're individuals and sometimes they come in groups, and they're definitely investing in the startup or growth phases. Those are usually the preliminary investors that you don't have full proof of concept yet. So they're believing in you, right? Because you've shown them, hey, I got some seed money from a couple of other places. We're off to a good start, but we're not quite ready for the next level of investor yet. So definitely still look at that angel investors or angel groups in the less than 2-year mark. A new and upcoming concept is family offices. So family offices are basically ultra high net worth individuals that invest in businesses, usually in the growth and expansion phase, because some company is managing their family office and they've decided that they're going to take $100 million, carve it aside, and invest in women-owned businesses. So if you get in front of a family office, you definitely want to be able to show this financial health already exists. And we'll get to that specific list. But now you're definitely getting into more complex investors that need to see, reliable financial statements and all these other things that I'm going to list later. The venture capital, also known as VCs, is usually what people call them. They can invest anytime after the seed phase, but they definitely like proof of concept. So just depending on how quickly your business is progressing, a VC group is going to want proof of concept. And that's more of the Shark Tank, right? Like a Shark Tank, that's like the VC level.
Yeah.
They can contribute money, but they can also contribute other things that your business may need, like contacts at a retail company, that's going to promote additional sales for you. That's really where they can be most effective. It's not just the money, it's that they've got other avenues to help your business.
So there's a question, Ebony, from Jershale. She says, when requesting a loan, how important is it to have a nonprofit or a sole proprietorship, an LLC or a corporation? As a consultant, I process business under my name and social security number. So it sounds like, Giselle, you don't have a business registered with the state.
Right. So I will tell you that there's two answers to that question. As a bank, I only care that you have a registered business entity if that's who you want to get the loan under. If you're saying you want to take that personal liability for the loan, then you're operating under your own personal name. If you want to put the liability into the business, regardless of the corporate structure you choose, I am not a tax attorney, so that's who you need to talk about, the type of structure you want. Mm-hmm. That's really the difference, is whether you're looking for a personal loan. Because if you come to the bank and say, I have a business, but I'm applying for a loan in my personal name, then we're going to give you a personal loan. It's not a business loan, even though on the flip side, you're using it for your business or whatever. Mm-hmm. So really the business loan is identified as that because you have a business entity that you're applying for the loan under. The next step to that is if you have a business loan and I say, your personal strength is part of it, then you become a guarantor of the loan. The loan is not in your name. You're just guaranteeing as the business owner that this loan in my business name will be repaid. Does that make sense?
Yeah, it does to me. Giselle, if you want to expound on the question, then definitely feel free if you have more questions on that. But yeah, that it makes sense to me. Melba asked a question. Can you kind of clarify a little bit more accelerators and incubators? Can you clarify a little more on these two?
Okay, so business accelerators and business incubators are somewhat a new concept over like maybe the last 5 years. I can give an example of like Georgia Tech will have a business incubator where they create an environment for people with seed or startup phases of businesses to come in and they help you with the missing pieces of your business. Sometimes that's startup money and they'll say, we're going to give 5 companies 20 grand that are in the IT category. And then, they'll create some kind of application process where, Georgia Tech wants to focus on IT. Maybe if it's a healthcare incubator, they want to focus on healthcare innovations. Usually they have some kind of qualifying criteria that mm-hmm. you put your business idea into. And then the incubator part of it or the accelerator part of it is them filling in the gaps on the missing pieces, i.e. if you didn't have a CFO, maybe they'll contract you a CFO. If you don't have a marketing person, they'll help you with the marketing strategy or your website. So they're all very different, but they are very common. And sometimes you can get some seed money based on your idea and they will help you with the missing pieces for your business growth.
Gotcha.
So let me know if you have any more questions about that. But if you start Googling it, there's several in Atlanta, obviously being the city that we are, and they're popping up all the time. For different purposes. And, it's just another good resource that depending on your line of business, once again, it's harder for service-oriented companies, but if you have a tangible piece of merchandise, then those are kind of the ones they will gear towards. So corporate funding usually comes when there's some level of an exit strategy. You create some special chip that goes in a Verizon phone and then Verizon buys your company because they, it's going to help them with their growth strategy. That's very rare, but usually it's very specific to manufacturers. Government funding, we talked about, that's, in the grant pile, pretty restrictive. And then banks, we've already talked about, that's really after the seed and startup phase. Okay, so here's another myth I always like to debunk is the amount of money we deposit each month determines the value of my business. And let me just expound on that a little more because people will say, I run $12 million through this bank every month and I deposit $1 million a month. Well, if your average balance is only $20,000, personally, the bank doesn't care how much you run through it because you're using them as a service versus if your average balance was $1 million a month, that would be different. So understand when you're talking about what you think the value of your business is, it's really based on not how much money you're running through your month. Now that's how much revenue you bring in, but that doesn't really tie to your profitability, right? Like just because you have 12 million in revenue doesn't mean you're a $12 million profitable company. And a lot of people get those interchanged, but from the banking perspective, we value your business based on how much money you leave in the bank, not how much money you run through the bank. So everybody likes to talk about how much money they put in the bank, but it's kind of like we care about how much money stays in the bank. And that's a business decision for us, right? A bank is a business and we make money off of lending your money. So if you're taking it out before I can lend it, not that much value. But when we talk about revenue and profitability, then yes, you're a $12 million revenue company, but now you really got to back into your value of your business is really only your profit, not your revenue.
That's good to know. That's really good, because I can only imagine people coming and expecting how much they have coming through. You ought to be able to give me something because I have this much coming through.
I hear it all the time, and I'm just like, that is so great. I'm happy you have that much revenue, but what does that really mean? If you're making $1 million and spending $990,000 of it every month, you still only have $10,000 to pay me back. So you can't get $1 million loan. Sorry. Yeah. So let's see. So I just want to talk a little specifically about banks, because I feel like that's where a major misconception is about how to get a bank loan and all that kind of stuff. Banks are very relationship driven. And I use the bundle services because that's like a common word now when we bundle all of our, cell phone and internet packages together at your house, right? So when you talk about bundle services at a bank, there's so many more services at different banks than just loans. You become valuable to a bank the more services you have with them. So it's actually behooves you and your business to start with something other than a loan, because now you're adding value. And value for them is revenue, right? Just like your company is revenue. So if you're bringing revenue to the bank, adding other services is beneficial to establishing your relationship. So now when you come in and talk to your relationship banker and you say, these are the other things I'm doing with you, can you please consider me for a loan? They've got something else to hang their hat on. And it's not that deposit myth we just talked about. That doesn't make money for the bank, really. When I talk about services, I mean, if you're a retail company and you accept credit card, somebody has to process those credit card transactions. Banks make a lot of money off that. So offer your merchant, that's called merchant services, but that would be a service that you could offer to the bank that you want a loan for. So that's one of the things is now we care about that you're running $12 million through your account every year, because if half of it's credit card, that's revenue for a bank. Does that make sense?
Makes good sense, yes.
Okay. So there's all kinds of things that business owners actually do have leverage to use. And that's what you need to think about when you establish a banking relationship. If you have employees, you might be paying a payroll service. Your bank might offer that service, and that's something else that you can say, hey, I do my payroll through you guys. I do my merchant services through you. Those are things that you can bundle together and say, now I'm asking you for a loan because you guys are tied to my business in so many different ways. You can see how well I'm doing versus just coming in off the bat and saying, can I have a loan?
That makes sense.
I also want to point out, and I mentioned this earlier, the bank's capital is really your least expensive investor. They don't ever take equity in your business. That's not what banks do, commercial banks anyway. And when it's all said and done, the capital from a bank is overall going to be cheaper than capital you get from anywhere else, unless you're getting a grant and you don't have to repay it. Apples to apples. You want to build your business to the point where you can use bank capital, which is the whole point of this. If you even use other funding sources now, like hard money lenders, or sometimes people get contracts and they use factoring companies, that capital is so expensive. You want to get to the point where you can have a working capital line of credit at a bank. And that's really the ultimate goal, is to be able to pull that money from the bank and pay it back.
And can you kind of describe what a line of credit, having a line of credit at a bank as compared to taking out a loan?
Okay. So a line of credit is going to operate like your credit card. It's called a revolving line of credit that you can draw down and pay back and use the availability of it. we call that a working capital line of credit because you would use that on your regular monthly business expenses, whether it would be your utilities, buying, not buying equipment because you want a loan for that, but purchasing new inventory, things like that, that on a monthly basis, your company purchases and pays back. You really want to use that. Like, it's not outstanding all the time. You have, let's say, $100,000 line of credit, and you want to, use $50,000 of it in a month. You don't want to buy a piece of hard equipment with that because you want to be able to pay it back. Equipment is a longer term financing mechanism that you would use a loan for, but your line of credit is really for working capital. So things when you purchase something on a monthly basis, that the regular bills that you pay back, which is really how you should operate your personal credit card. But that's the whole point. It's called revolving because you're in and out of it. You use it and you pay it back. But the point is, if your business is in growth mode and you get a new contract and maybe you have to hire 2 new employees really quick, you need that line of credit to be able to maintain that growth. And that's where a lot of times we fall short, is we don't have the capital that matches when we're ready to grow because we haven't done all these other things to get ready to have a line of credit. Like that's not something that's easy to get. You really have to show, yes, I can repay this.
Yes. Let me see. There's a question that says, is there a percentage of money you leave in the bank and a percentage paying for your business? So I think the question is, if I'm making $12 million, the example before was I was actually leaving 10,000 in the bank. Is there a percentage of, if I'm making 12 million and my profit is a percentage or a number that I'm making to be able to show the bank I'm credit worthy?
Okay, so I understand the question, but the answer really is about building a strong balance sheet for your business. If you truly have a separation of your personal and your business, the money left in the bank should be your profit. And that's why I use the 10,000 as an example, because after you pay all expenses, what should be left in the account is whatever your profit is. So yeah, that's how much money you should leave in there. Now, if you're commingling funds and you have to take money out for other purposes, now you're not truly using this as a business account. So for a business account, the money left in there at the end of the year should be your profit in total, right? And then you decide as the business owner if you want to take a distribution. Really, that should be an official thing that you do, and you say, you know what, my business made $100,000 this year. I want to take 50,000 of that out. Now, to answer your question, that's where the bank comes in, and we say, that's great. We see you only take 50% of your profit every year. That concept is a little bit different than what I leave in the bank every month. But conceptually, we like businesses with strong balance sheets that show, yes, we make money and we leave money in the company just in case something goes wrong.
Gotcha.
Not we pull every penny out every chance we get.
Yeah, that makes sense. And
that goes back to the capacity of the 5 C's of credit. That's where capacity comes in, is it in conditions. If something goes bad, do you have any backup in your business to support it? Or are you going to have to dig back into your personal pocket? We like to see a business that has built up their own backup in the business.
Gotcha. Tracy asked a question, can you speak to personal guarantees on the line of credit versus the business fully holding their debt?
Okay. So yes, I can. So, and that really is institutionally based. Some businesses, some banks, like Bank of America, at a certain point, we're going to say, yes, you have to guarantee your business line of credit as an individual. If not even just to say that you have as much skin in the game as we do. If you are an individual business owner and you control all rights to this business could make $1 million. And if you pull it all out tomorrow and run away with it, we have no recourse back to you. So the reason why we make you personally guaranteed is say, okay, you can pull the money out if you want to, but then we're coming after you individually to get it. Which once again goes to the separation of personal and entity. So if you have an entity that gets a loan and we give the loan to the entity and we don't make you personally guarantee it, then how do we get the money back if you take all the money out of the company? So that usually happens with independently owned and privately owned businesses versus corporations, who we don't make you do a personal guarantee because there's other restrictions on you pulling the money out. But if you have a company that I can take every penny every month, then we're going to make you personally guarantee it.
Gotcha.
because there's kind of like, you are the business, right? Especially
Mm-hmm.
if it's a service business, you are the business.
Yep. Gotcha.
Okay, so we talked about the 5 C's of lending, and now through the discussion, you can kind of see how it all flows into everything, right?
Mm-hmm.
We kind of talked about avoiding deal fatigue, and we'll get to the point of building up all the things you should have done before you go into the bank in the next slide. But basically, that's about understanding your business. You want to be able to check all these boxes before you go in there. So we talked about the type of business it matters, and that was whether it's a service business, merchandising, manufacturing, not necessarily the structure, which is what the other question was about, LLC versus corporation or sole.
Mm-hmm.
That is not really what the bank cares about. We also talked about personal financial strength for your small business is important. You know, once again, some other things that you can add to that is collateral for a loan. They will take your personal collateral, even though it's still a business loan. You can use your residence. Some creative things people don't think about is if you have a whole life insurance policy with a cash surrender value, you could get a loan against that, because if the bank had to, they could cash in your cash surrender value and have some collateral.
Mm-hmm.
Or think of any other hard assets, especially when you're in the startup phase. You really got to sit back and take a look at what are my personal assets that I have that I could possibly get a startup loan with. Most people, as business owners, you should do a personal financial statement. I actually could have sent one. I'll send one, because that kind of breaks down all the things that they're going to ask for when you do apply for a business loan. They're going to want to know your personal strength, whether you have a 401k somewhere, how much equity you have in houses, if you have a rental home, you know, all your sources of revenue. That's really where your net worth comes into play, but you can really start identifying whether or not you're strong enough personally to guarantee a business loan.
Gotcha. That's good.
So I'll definitely email one of those out, just because for your own personal benefit, everybody should do one. If just to understand what that really means.
Awesome. I'll send it out when I send the recap. I'll send that along with it so people can download it.
Okay, perfect. So now let's talk about all of this information and how that makes a healthy financial business. So if you want to go ahead and do the next question, because it relates to...
Okay. Let me ask this question from Tracy, which is, can you speak to building the credit in your business?
Yes. So that when you talk about building credit in your business, part of what I was saying about establishing a relationship with a bank is part of that credit building process. Unlike our personal credit scores that we have, a bank does not base a business loan decision on a specific credit score, even though I know they exist.
Mm-hmm.
Got all other kind of things that come into play, which is everything we've been talking about. So to me, the best way to build your business credit is to establish that relationship and show them you do things like you have a business credit card that you pay regularly, and then no overdrafts on your checking account. You know, all those kind of things that helps you build a relationship with a bank, that when you're ready for bank funding, that builds your credit versus trying to get to a certain score and say, now I'm ready for business funding. Because really what you're talking about is what like capital funding companies use that are online. And that's different than a banking relationship, because what we want to do is get people to the cheapest capital possible, which is a bank. It's not going to be one of those online capital sources. So there are ways to build your relationship with a bank that when it's time for that loan, that's what you want to do.
Gotcha. Thank you. Okay, I'm going to launch this poll. And the poll question is, do you utilize the skills and knowledge of a financial professional to review your business financials? So internal, do you have a CPA or CFO that is a part of your company? 2, do you contract a CPA or a CFO to handle your finances, or DIY? You handle it and do it all yourself?
So while that question is being answered, I will just say that plenty of statistics show that financial literacy, it is very normal for people to not understand budgeting and cash flow and balance sheets, income statements, all of these statements that exist when you have a business. And when I talk about reliable financial statements, people get QuickBooks and they put information in QuickBooks, and that's great. But if you are not a true financial professional, that information can only take you so far. And we'll talk about all the reasons why I asked this question, because where we lack is establishing that financial professional in our organizations, because we think it's another expense. Oh, I can just do it myself. But the financial statement is more than just profit and loss, right? It's talking about how you analyze financial issues within your company. Another example, I have a $12 million company and I just got an opportunity for another $10 million contract. Everybody thinks, oh my gosh, I can almost double my revenue with this one contract. The question is it profitable? Do I really want that contract? Do I have the means to perform on that contract at the same profit margin that I do now? And if you're not a financial professional, it's really hard to figure that out.
Mm-hmm.
You're great at all other aspects of your business, but that financial literacy part is very real, because a lot of businesses will fail because they took on too much and didn't realize they couldn't afford to do that. So just because you have a bunch of revenue doesn't mean you have a bunch of profit. And that's what financial professionals do for you. They help you understand what's a good financial decision for this company. And it's not just all about revenue, which is usually what we think. The more revenue, the better. No, it's the more profit, the better. So if you should stop at $15 million in contracts, then you don't want that $10 million contract, because that puts you above the level of you being profitable.
Yeah, that's so true, because one of the things, when I started, I was DIY. I was had a software system that I was using to kind of manage funds going in and out of my company. But I was asked to do a proposal for a company, and it was going to be a 6-figure contract to get the contract. But as I started to go through the proposal, first of all, you're like, oh, yes, this is going to be good. But as I started to go through and put the pieces to present the proposal based on the outcome and the RFP and what they needed, I wasn't going to make a lot of money on that contract at all. So because I was going to have to bring in so many different people, different moving parts, add different things to it. And it was working with my CPA to say, here's what I got, here's what I want to do. And when I looked at it, I could kind of see it. But when she looked at it, she was like, here's what the profit is going to be. And then I had to think, is this even worth the work to do it? So should I turn it down? And I only learned that from working with as a subcontractor and people who were the prime on the contract, had $1 million contract, but barely breaking even based on the cost and the amount. You think it's $1 million, but it's going to cost you, $800,000 just to do the project, period, with everything that they're needing. But having that CPA to look at some things, when I first brought a CPA in and looking at my business, I mean, when I tell you bells and whistles there was all kind of, it's like, why are you doing this? And what is this for? It's like,
I don't know.
This was exactly. Well, I was like, no, that's affecting you. And so, yeah, that was serious right there.
Yeah. And I'm so glad you said that, because that's basically what I mean. I'm like, financial professionals, that's what they do. We don't expect all business owners to be able to do that. So let me take that step to what the bank expects. The bank expects for you to be using somebody to do that. So if you can't prove to me that you have that expertise, then you should show me somebody in your organization that does. That's what we want to see. We're not saying you have to be that financial professional, but we need to know that somebody else is helping you through this financial piece, because we don't want you to grow too fast, right? Like that's basically what you're saying is, I had the opportunity to grow so fast, but it really wasn't worth it. So now as the bank, we're looking at it like, you increased your revenue, but you didn't increase your profitability.
Right.
That doesn't help us.
Good.
So that's a very important thing I need everybody to understand, is that's an investment you need to make. So what comes out of that is reliable financial statements, right? So there's the concept, well, this also goes back to the strong qualified management team, right? You having somebody with some kind of financial experience in your management team. And once again, showing that historical performance. But specifically for the financial statements, when we talk about quality, we talk about garbage in and garbage out. And I say that tongue in cheek, but I really mean that if you're not a financial professional and you're trying to input all this information into QuickBooks, you won't know if you messed up something, right? It's kind of like, I just put it all in there and you're like, why are you putting this expense here? And it's supposed to be, whatever the case may be. So from that standpoint, a healthy financial business has quality financial statements. And usually they're CPA prepared, unless you have a CPA internally. But even still, like, that's the quality that we're looking for to say, when I say bring me 2 years of financial statements, I don't want you to bring me QuickBooks. And if you do, understand that's going to affect our decision-making process. I'm not saying we won't do the loan. I'm just saying that's another criteria that we say, okay, you're going to have to prove to me that if you're a do-it-yourself, that you really understand what these numbers mean.
That's good.
And so from the management team perspective, that goes back to understanding the industry and the peers, right? We're looking at the bank. The bank is looking at it like, do you have a strong enough management team to manage what you're saying, basically, in your business plan that we don't read, but you're telling us these are all the things I'm going to do, but you got to be able to justify it with your management team. And once again, it really comes down to financials, whether that's sourcing revenue, deciding whether or not a contract is profitable, all of those kinds of things. And the business plan, we want to know that you have one, so you're staying on track with your company goals. Is this management team really following this plan? So once again, back to the historical performance on revenue. We like to see a healthy business has increasing revenue. I'm not saying it's got to double every year, but the trend should be going up and not down. Okay? So from a point that you start your business, if your revenue is trending up, that's healthy. Now, I'm not saying your revenue is never going to go down because maybe a contract ended, but that goes back to being able to explain why it ended. So you got to know your business. Your management team has got to say, here, this contract was over, but here's what's next in line. All of that discussion is what helps you get a business loan. And that's what I mean by different than just filling out some answers on a piece of paper, right? One thing I always like to point out goes back to contracts, right? Let's say you have $1 million business, and then all of a sudden you get another $1 million contract. That actually doesn't look that good to us because now you're a $2 million business and 50% of your revenue is coming from one source. That's not that good. So, because if
you lose that one source, everything, you lose
everything goes, you're right, especially if I loaned you money based off the $2 million, right? Like, I'm looking at it from the bank's perspective, like, oh, you said you were a $2 million company. So just keep in mind that all of these other factors come into play. A healthy business financially has multiple sources of revenue. And that 35 to 50% is kind of the cutoff mark and a red flag for a bank saying that's too concentrated. I need you to diversify a little bit. Otherwise, you're not that attractive to us. I don't care how much revenue you have, because we're risk adverse, right? We don't want to take this risk. Okay, so we talked about the 2 to 3 years. So specifically, when we're reaching the end now, which is good. So my advice to what's next is really to establish a relationship with a bank. And these are things that you can do that we talk about building the healthy process. Business credit card is a great way to establish your business relationship. Get a deposit account and don't have any overdrafts. Sometimes, depending on the bank, that's the first thing they do is they look to see, have you ever overdrawn your account? Do whatever you can to make that number always be 0. Find a CPA, either hire or contract them. That is, to me, shows your financial health, because at least you're understanding the numbers. And get educated. Like, I know people that just take an online accounting class. And I say that to say that if you end up contracting with a CPA and now you're talking with the bank, you want to be able to understand the questions they're asking you, because that just shows that you're a diligent business owner. You know what I mean? You don't want to put all your eggs in the basket of your CFO if they're not there full time with you. Now, depending on the size of your business, when you reach a certain size, like, I only talk to the CFO as the banker. But if you're really a business owner that's involved in everything, I would recommend you take some kind of online class or use some other kind of resources to basically start building this healthy financial process.
Makes sense.
And I think that's all I got.
That was when I tell you I got notes all over the place. Ebony, this is really good. And even in the categories, the seed and development, launch to startup, growth and establishment, understanding where your mix is there helps you to kind of understand also based on your products, services, manufacturing. I know one of the things with service-based business, a lot of service-based business are like, so will I not be able to get a loan? But one of the things that I've learned with service-based businesses is when you are able to show those different revenue streams and have recurring revenue, it looks good because it's coming in consistently and often as you start to build. Because there are several companies that I know that are service-based businesses that have received funding, but you can't just say, hey, I'm coaching and I need to grow. There has to be some strategy and some plan. Let's see, Dr. Randy says this was highly informative. Thank you, Ebony, for what you've trained. Any other questions? We have a few more minutes for questions. We're scheduled to 9:30, so we have a few more questions. What questions do you have for Ebony that she can answer for you now? And what's this? It was definitely helpful to me. I definitely took a lot of notes.
Well,
so I'm going to ask a few minutes to put your questions in.
And I was going to say, all of those categories can go down a rabbit hole, whether it's financial statements, whether it's, should I take a new project, all of these things. And that's why we just tried to keep it high level enough to scratch the surface that, it's more than what meets the eye sometimes when you're looking for funding. Investors like to see proof of concept, but it's not going to necessarily look the same for a bank. The banks are very specific about their criteria. If you're looking for investors, there's tons of online resources that you can find, investor groups that, will target specific groups or specific industries. But the basics are still pretty much the same. You need that reliable financial information, and you need to understand your business, what concept, what your future sustainability is, all of those things. Help you understand that main question, like, how long can I sustain this? Because maybe this is a business that's only good for 3 years. Don't stay longer than you have to. Do what you have to do and get out. If you're in business, usually it's to make money. And to the nonprofit and for-profit, dichotomy, nonprofits don't have to be not profitable. You can still make money with a nonprofit. So don't get it twisted like it's a volunteer work and you're not making any money. A nonprofit can still make money if you use the same concept of operating a for-profit business. So
here's a couple of questions that have come in. When should you start paying yourself, and how do you determine the amount that you pay yourself as a business owner?
That's the one thing I would talk about. You want to pay yourself as soon as possible, first of all, because you want to show sustainability. Banks are not stupid. If you come to me and you show 2 years of financial strength, but you haven't been paying yourself, I'm not going to think that that's sustainable. You know what I mean? So it's one of those things. Even investors, they say, well, you got to pay yourself. Otherwise, how long can we expect you to keep doing this? So you want to pay yourself as soon as possible. The amount really is based on your peers. Like, once again, that's kind of a valuation thing. Like, you need to do some homework and find out what your peers, meaning industry, service type, and revenue size, are paying people in that equivalent position. What are the founders paying? If I have $1 million law firm with 3 employees, what does the main founder take out at the end of the year, or even on a regular salary basis? So that's really where your peer profile comes into play.
Oh, that's good. So let's see. Jershelle said, thank you, ladies, for your time tonight and sharing your knowledge. I have 4 pages of notes, and I feel really inspired to grow my business. And also, let's see. Andrea said, thanks. This was great info. Banks say no, but they never explain why or break it down. Thank you for explaining why. Let's see. Regarding building a solid relationship with the bank, how important is it to connect with the bank's merchant services? And I know for me, and you can answer that question, I know for me, that was one of the things that when I first started a business, one of the things my coach said was you need to start building that relationship. And so I would go into the bank, and they were like, anytime you have something going on, something new, go into the bank. So I would go into the bank and see my small business rep, and I'd be like, Jay, let me tell you what I have going on. And anytime I had new products, I would share with him. So if I was going to the bank just for personal reasons, he saw me, he was like, hey, Becky, what's going on? But it helped to build, he knew me and I knew him. And so that's always, to me, it just feels good because people are doing business with people. And so if not building a relationship, I think what is critical to me. What's your perspective on building those bank relationships?
No, I agree. And merchant services is just an example of one of the services that your business may need that you can take to the bank. And the whole point of building the relationship with the banker is so you can have an advocate. You don't want to be just filling out an online application, especially if you can't check all these boxes with, oh yeah, we got $1 million in the account. If you've got any shortfalls in your business financial health, that advocacy of that banker is what's going to get you over that hurdle. Because that was my point about saying is like, this is not cut and dry like a credit score. There are some flexibility decisions that can be made in the background. We have credit underwriters that look at this business and say, look, they've been banking with us for 4 years. They've got all these products with us. They do their payroll through us. They have a business credit card, and now they're looking for $50,000 because they just got a new contract. That having that advocate on your side is absolutely going to help. So in addition to merchant services, you think about all the things that your business needs from a financial provider that you might be piecing together, and think about putting that under one roof.
Gotcha. Lisa asked a question, is there any grants that you can recommend for new starting businesses?
I actually don't, I don't have access to grant information, but I know if you Google that, it's a pretty easy system to figure out, because there are websites out there that now will say, put in all your criteria and here are the grant options.
Yeah.
I know that that's available, but I don't have any off the top of my head.
Got you. Let's see. Angela says, this was amazing. If you are a startup and looking for investors, is it a good idea to anticipate buying them out down the line with a bank loan product to reduce the percentage owners shares that's outstanding?
Absolutely. So once again, this goes back to how sophisticated your investor group is. But remember, when you're dealing with investors, the benefit is you get to negotiate what that investment looks like. So if you are a business owner that wants to be able to take a financial investment now, but always have control of your company, remember, you're creating what those investment documents look like. And this is a whole nother conversation that we can get into detail, like a whole separate series, but they can invest partially debt, partially equity, but think about it as simple as everything is negotiable. So if you as a business owner, which I strongly suggest, you already know what type of investor you're looking for.
Mm-hmm.
That's your presentation to the investor. You're saying, I'm looking for an investor to give me $100,000 and I'll pay you back in 5 years, and then you no longer have equity. That's what you want to put out there. Like, you put out there what you want, unlike the bank, who we kind of set the terms. But
Mm-hmm.
when you're looking for investors, you get to set the terms. Otherwise, that's not the right investor for you.
Oh, that's good. That's really good information. Melba says, I think this was based on your a response before. Transfer your salary from business account to personal account, and it's a question mark. So I'm assuming this is on should you pay yourself?
Yeah, and so paying yourself in your business is not a bad thing. Everybody expects that. Nobody is in business not to make money. That's the whole definition of business. So a bank or an investor is not going to look at it like, oh my gosh, you pay yourself, unless you pay yourself way too much. So if you have identified a salary in your company that you say, I'm going to transfer $5,000 a month, that's fine, because that's a business expense, right? That's in your budget. The question is, when you go over that amount, or if you're just doing a random number, then do you really have a budget for your business, or are you just pulling money out the company? So the actual transfer process is not a problem. It's showing that, yes, this is $5,000 going to myself for payroll, and as long as that's in the budget, that's fine.
Gotcha. Got you. So it's a lot of thank you, Becky and Ebony, for this training. It has given me a lot of insight on restructuring my business to increase my value. I have been truly enlightened. Me too, Gia. The same thing. And Sylvia says, thank you. Melba says, thank you. This has been an eye opener. Sylvia says, thanks, this was great info. I answered that question. She wanted to know, will she be able to review the information? And I just responded, yes, I will send it out. The replay within 48 hours, it will go out. So let me just say thank you to everyone who jumped on this call. This is exciting. We're going to be doing some more of these with Ebony as she continues to help us take a deeper dive in positioning and getting ourselves ready for funding. This was really huge and critical because a lot of the stuff that she shared today just has my mind going all over the place. So I'll have my whiteboard out, writing some stuff down too, for my business to help put some strategy together to get yourself in position for funding down the line, whether you need it or not. You need to position yourself for it because you never know when it could happen. So this is some good information. So I'll be sending out the replay in 48 hours, and I'll send along the personal financial statement form that Ebony referred to so that everyone can download that as well. And we'll be doing more of these with Ebony throughout the year so that we can continue to prepare ourselves to really get funding and keep ourselves open, because the two areas, this is just major information, especially for women of color. We are starting businesses at a higher rate than anyone else, 3 times more than anyone else. The opportunity lies is we're not keeping those businesses open. And there are 2 reasons why that's not happening. And one is resources, funding as the top 2 areas. And so to be able to understand, and I think the biggest opportunity is we don't know what we don't know. And I'm so grateful and thankful to Ebony for helping to educate us because there's a lot that we know tonight that we didn't know before 8 o'clock today. So Ebony, thank you so much for taking the time out to share with us and with our community. So guys, I'm going to say good night to you, and we will I'll get this out to you within 48 hours. You'll get the replay of everything. Thank you, Ebony.
You're welcome. Sounds good.
All righty. Bye, everybody.
Bye.